The oil industry prepares to drill off the coast of northern Alaska. I'm Peter Latman, reporting for Business Day Live. We'll hear later from Clifford Krause about what it took to get access to Arctic oil reserves. And Louise Story brings us an interview about a new era in shareholder activism. But first, I'm joined by Michael de la Merced with the latest on Facebook. Hey, Michael.
Hey, Peter.
Thanks for being here. So here we are almost a week after Facebook's IPO, and people are still talking about it, and the controversy is still swirling. What's the latest?
Well, Facebook shares finally traded up yesterday. They're still well below their offer price. They closed at 32 flat yesterday, and Facebook had actually priced its IPO at 38. So a lot of people are still thinking it's a bit of a disappointing offering.
Yeah, okay, and now you're starting to hear from regulators and investors who bought into the deal and say that there was some unfairness associated with the offering. What's going on there?
Sure. So one thing that's emerged is something that actually happens in a fair number of IPOs, is that Facebook told some research analysts, about 20 or so, about they gave a little more detail as to how their revenue growth was slowing a little bit. They were having some trouble with mobile.
Before the IPO?
Correct. Yeah, a couple
So
of
this
days.
is big investors like Fidelity or Capital Research, big institutions that run mutual funds knew ahead of time that Facebook's revenue was slowing.
That's right, because the research analysts went to their clients and told them, hey, we're lowering our forecasts.
And if you're Fidelity, you might say, well, then I don't want to buy 10 million shares on the offering. I want to buy only 2 million shares on the offering.
That's right.
But if you're a dentist in Kansas City buying or putting in for Facebook stock on, say, E-Trade, you don't have access to the same information.
That's right. And the funny thing is that the regulations allow this. Analysts can go and talk to just their clients. They're under no obligation to tell the wider public what they've learned.
So is this discrepancy now making regulators raise their eyebrows and asking themselves, should this be the rule?
Well, that's the thing, is that right now it is the rule, but you can bet on congressional committees and others to ask whether we should change the rules.
Yeah. So there was all this fanfare about the Facebook IPO, Mark Zuckerberg, being lionized and the company being worth $100 billion. And here we are a week later, and Facebook is being criticized for pricing itself maybe too high. Morgan Stanley is being criticized for being an accessory to that high-priced IPO. And the NASDAQ, where the stock is now trading, is also being blamed for an ineffective public offering. So is everyone to blame here? Was this a complete disaster?
I think if you talk to people within the offering, they acknowledge there are a lot of people who share some of the blame here. But it's also important to remember that Facebook has been public for less than a week. Amazon traded below its offer price for months, and look at where it's trading now.
Right, so come back in 6 months or a year and we'll take stock of where things are.
That's what everyone's hoping.
Thanks, Mike.
Thanks.
Shell Oil plans to start drilling test wells off the northern coast of Alaska in July. The opening of Arctic waters for drilling marks a dramatic policy shift by the Obama administration, 2 years after the Deepwater Horizon spill. Clifford Krause reports on why Shell spent $4 billion for a chance to penetrate the last domestic oil frontier.
This will be the first time that oil companies drill in Arctic waters in Alaska in over 20 years. It's momentous because this is considered to be one of the last great oil reservoirs yet to be tapped in the world. We're talking about the potential of 1 million barrels a day of oil being produced, which would be more than 10% of what the United States currently produces. And in the future, in about 10 years, it would definitely make the United States more independent, not absolutely independent, but more independent of foreign sources.
And that's part of the winning argument that Shell used here, right?
It seems that the Obama administration, at least in this decision, has decided to put aside environmental concerns in order to assure more political and geopolitical stability when it comes to energy.
There was a lot of lobbying on behalf of this, and it seems to me that Shell was very savvy. In addition to courting the Eskimos and the native population, they worked in Washington to get the message across that, hey, this could be good for even things like climate change issues.
They made an enormous effort on two fronts, as you say.
Mm-hmm.
But at the end of the day, this was a decision made by President Obama.
So we're assuming that Shell is the first, and it's starting with these test wells, but then others will presumably want to follow.
Yeah, there's a line. They've been having auctions, the federal government, and already Statoil and ConocoPhillips are in line. They've let Shell take the lead. Unless there is a last-minute gambit that stops them by the environmental community and the courts, and at this point that looks like it will not be successful, Shell will proceed, and then the other oil companies will follow suit in the next 2 years.
Even after the Deepwater Horizon accident in the Gulf raised great concerns about how safe drilling of various types can be, and I recognize this is a different type of drilling, it's not so deep, but do we have confidence that we could handle a spill on ice, for example, or in these kinds of weather conditions?
You know, this is probably a lot safer. This is definitely safer to drill, but more dangerous if there is an accident. Despite the fact that Shell says that it's taking all kinds of procedures and precautions with containment, it really could be catastrophic. And that's the big gamble here.
Does this tell us anything larger about the administration's energy policy?
Well, what it tells you is that this administration is zigging and it's zagging. The last big decision was on the Keystone pipeline, in which they basically delayed a final decision. And that decision, of course, the oil companies hated, the environmental movement liked. This is a decision which the oil companies are going to like, and the environmental community will hate.
Finally, shareholders are exerting themselves in corporate governance issues on everything from executive pay to risk assessment. My colleague Louise Story interviewed Richard Chambers, Chief Executive of the Institute of Internal Auditors, about why they are speaking up.
I think to a certain extent maybe we're going through a bit of a crisis of confidence on the part of some of the shareholders. I think they're concerned maybe that their boards haven't been strong enough in overseeing risk management and setting the risk appetite of the company and in helping to assess performance of the key executives in light of the risk appetite. I think one of the things as shareholders, I mean, if you think about any of us who are investing in companies, we want to make sure that company is taking on the kind of risks that we expected it would when we invested in it.
Right, and of course this is coming up now with JP Morgan. They just had the huge trading loss. And it's unclear if JP Morgan shareholders really think that bank would be taking on those kinds of directional bets that are leading to maybe $4 billion in loss.
The board has to be in touch with their shareholders. They have to bring that sort of skepticism to the table when they're sitting there and helping to work with management to frame the risk appetite. I sort of think of risk appetite as like painting the lanes in the highway. And then the management ought to stay in the lanes.
One we saw just a few weeks ago was at Citigroup, Vikram Pandit. The shareholders did not approve the pay of the executives there.
Yeah.
How common is that shareholders vote down executive compensation? Well,
as I understand it, it was pretty uncommon last year, which was the first full year of the safer pay regulation that the SEC
and the safer
adopted.
Pay, that gives shareholders the right to even vote on compensation at all.
Right.
Is that binding? Do the executives have to do what the shareholders say?
No, they don't. Actually, it's a non-binding resolution.
So what's the point of it?
Well, I think what it does is it's a strong signal to the board as to whether they're in tune with what their shareholders' views are.
There's one board member really in the hot seat this week with Goldman Sachs. James Johnson is on the board there, and there have been a lot of shareholders pushing to vote him out. How common is it at companies to have shareholders vote a member of the board out?
I don't think I've seen a lot of it. I mean, again, I think we're just entering a bit of a new era where shareholders, through some of the recent legislation and regulations, are a bit more empowered to speak their mind and to be able to register their discontent. What I really would hope is that there's an opportunity for shareholders to play a legitimate role and an important role in helping to identify and select the board. If shareholders feel confident that this is a board that they elected and that board shares some of their perspectives about how the company should be run, I think you're going to find that confidence will translate into support for decisions that board makes.
That's all for today. Please stay with us online at nytimes.com for our continuing coverage of these and other stories. I'm Peter Latman, reporting for Business Day Live. Thanks for watching.